The US stock market on Thursday continued its upward trend following the Federal Reserve announcement to lower the interest rates by 25 bps. Now, this move by the Fed came as a response to the once high inflation that resulted in Trump winning the presidential elections, dropping down toward the bank's target of 2%. The rate cut brought a wave of relief in the American economy as the policymakers took note of the job market that has generally eased. The central bank started lowering rates in September when the Fed announced a 50 bps rate cut and signaled that further reductions were likely. The market's direction, even after the Fed cut, still remains uncertain as the result of Trump's win. Now, who is also advocating for tariff and other policies that could drive inflation higher as per economists. Now, in the bond market, the yield on the 10-year Treasury lowered to 4.33% from 4.44% late Wednesday. Opposing the surge it gained on the previous day. Now, the rise had been driven by expectation that Trump's plans of higher tariff, tax cuts, deregulation could boost economic growth, increase U.S. government debt and lead to higher inflation. But how do you as an investor look at this rate cut? What are the signals for RBI and how soon will your EMI go down? Let's understand all of this. I have with me Shweta Rajani, Head Mutual Funds, Anand Rathi and Devang Shah, Head Fixed Income Access Mutual Fund. Hi, good evening and welcome both of you. Devang, let me first come to you. So a 50 bps and then a 25 bps. What's the road ahead for Fed and what are those grey areas that Fed has highlighted in their entire commentary?
And definitely, I think you highlighted it quite well that last 2 to 3 years, if we look at the US economy, inflation has significantly shown a downward trend. If we look at 2022-23 average, the average inflation there was at around close to 6 or 7%. Similarly, 23 average US CPI inflation was around 5%. If you look across at 2024, now inflation has significantly come off. Now inflation is going around 2.5 to 3%. So yes, we have had the Trump getting elected and probably a lot of noise around higher tariffs and inflation coming back. But if you look across the current trajectory or the next 6 to 12 months inflation trajectory, US inflation might be hovering around 2.5 to 3%. With 2.5 to 3%, your Fed fund rates after the rate cut yesterday also is still in the band of 4.5 to 475. So you're talking about still a significant real rate of 150 odd basis, which has never prevailed in US. Hence, our perspective is yes, yesterday's Fed rate cut was quite given. We in fact expect another 50 to 75 basis of rate cuts in the next 6 to 12 months from Fed. And probably the trajectory might be that one rate cut we would see in December and then one rate cut per quarter till June or September 2025. So we see additional 75 basis of cut, and that's only and only because they need to realign. Even if Trump comes, the inflation in US should not go up massively above 3%. So the Fed fund target rate should be hovering between 3.5 to 375. So that leads to a 75 to 100 basis of cumulative cut from here on.
So Devang, what do you look as the trend for the bond yields now?
So our perspective is that obviously with US elections and Trump getting re-elected, the overall market, specifically for bond markets, the story becomes much more relatively weaker because generally the expectation is that you would have some bit of higher inflation. You can have some impact on currencies, dollar strengthening. But overall, the thought process is that it is not very good for bond markets. But how do I look at it currently is that we would see at least a 50 to 75 basis of rate cuts from Fed. We should also see RBI cutting rate because we might see some bit of slowdown in India. When it comes to Fed or US treasuries, we expect the US treasuries to probably trade in a range of 4 to 4.5 in the near term. We don't expect US treasury to significantly go above 4.5. As you pointed out, I think post the election outcomes, US treasury haven't moved. So it was largely in prices. Trump trade was largely in prices. So our perspective is that logically US 10 years should trade between 4 to 4.5 in the near term. Impact of that on Indian bond markets, our perspective is that Indian bond yields currently are trading at around to 680-85 band. But a large part, if you look at from the year beginning, we have seen a decent rally in Indian bonds. Indian bond yields were trading at 7 quarter at the beginning of the year, now trading at around 680-85 levels. You've seen a 40-45 basis of rally. Incremental rally in Indian bond markets would come with rate cuts. We expect 2 rate cuts till March, June 2025, cumulative of 50 odd basis. With that, we see 10-year GSEC yields going to 6.5 to 660 levels. So 40-45 basis rally already done. We incrementally see a 20-25 basis of rally from here on.
Right, so weaker picture at least on the bond yields front. But then, Devang, one more question to you. Rate cut from the RBI's end still off the cards because we'll have to wait for the inflation numbers coming up now?
A good question, Kavita, in fact. So our perspective is that there will be a hump in the near-term inflation. I'm sure Dr. Das also spoke about it, and we have looked at the trajectory. Veggie prices have not cooled off in October due to festive season and many other reasons. Again, early November also, the veggie prices have started seeing some bit of slowdown, but the trend looks lower than how it has been over various years. Generally, November, December, and H2 is good for veggie prices. Your Rabi crop has been good. So Kharif sowing has been good. Your output has been good. So our perspective is that food inflation will start falling. But your October and November prints, which are going to get released in the next couple of months, should be on the higher side. So December rate cut for us looks like a very, very remote possibility. In fact, I would see there's a very small probability of a December rate cut. We see rate cuts now next calendar year. Our perspective is that growth has started to show slowdown. High frequency indicators already are showing some bit of slowdown. You also spoke about that corporate guidance as well as the festive season demand has not been so strong. Credit growth has been weak. Capex growth has been weak. Government spending has been okay, but if you look across at there are early signs of slowdown in capex as well as urban consumption. All this cumulatively doesn't augur well for the growth cycle. So we believe that incrementally RBI might start thinking about, or probably they might revise their GDP trends to be lower, and which would help them or give them some guidance for rate cuts. We expect a 50 basis of rate cuts next year.
Right. So Shweta, let me come to you now. Obviously, we want to talk about portfolio reshuffling and rebalancing, and also what should be done on the EMI front. Should we really be ready for a few more months of high EMI? But then before that, I really want to understand the trajectory of gold. Will we be seeing gold prices softening now? Because can we say that they've peaked out, looking at the trajectory and the kind of cues that we are getting post the mandate? Shweta.
Sure. So, gold, if you generally see as an asset class, it tends to do well when there is uncertainty. Uncertainty, could be, let's say, a catastrophe like COVID when it hit, where there was complete uncertainty of where economies could go, geopolitical crisis, when the inflation is high. Those are the times when gold actually turns out to be a star performer. And but on the other hand, if you look at the longer cycles of gold, you will see that the gold plays out in such a way that for longer periods it would not move significantly, and then there could be these shorter volatile uncertain periods where gold just shoots up. Now, if I'm saying going forward, a lot of the events are behind us which could actually increase risk. So people are now getting onto a risk on mode, I would say. Risk off mode is kind of getting over. In such a scenario, we could expect gold not doing so well and going back to its, if I'm just talking about INR terms, going back to the 7-8% kind of a performance, which would come in because of the currency depreciation as well as the gold price movement. Gold per se has been around 3-4% over longer time periods. If you add the rupee depreciation, it comes to an average of 7-8%. So those kind of gold returns could be a normal phenomena going forward. So yes, I would say if I have to choose, between an equity and gold, equity would play out far better than what gold could play out.
All right. So on portfolio level, at a portfolio level, is it the right time to rejig our portfolio and maybe go heavier in equities? Would you recommend that, Shweta?
Absolutely. I would, looking at gold kind of peaking out, if I'm looking at, yes, we expecting rate cuts from RBI and therefore, a lower interest rate regime in the next 1, 2 years. In such a scenario, also equity performs better because under a lower interest rate regime, you would have corporate profitability improving, equity would get better valuations. So a rejig if you were heavy on gold and debt, but shifting that towards equity would definitely make sense. Just to give some ballpark guidance, I would say if somebody has a horizon of 5 years plus, you can consider having 60 to 70% equity. If you have a horizon which is, let's say, 10 to 15 years and plus, then having an 80% equity in your portfolio would also do well, would be a good allocation to have.
Right. One last question to you, Devang. And now, since the vote is towards going heavier on equity, any changes in the fixed income portfolio that you might want to recommend to our viewers?
So, see, from our perspective, we have been now guiding for holding on duration since the beginning of the 2024. Like, I think this year has been a very, very good year from all perspectives. It was a phenomenal year from macro perspective. You had a lower inflation trajectory everywhere, globally, India. You also had this entire favorable demand supply dynamics in bond markets in India, thanks to our bonds getting included in JP Morgan indices. And thirdly, I think somewhere down the line, this entire thought process was that we were significantly at a higher attractive yield of 740, 750 levels. Traditionally, if 7.5 and above on 10-year GSEC, it's a general buy. So our perspective is that, yes, we have seen around 40, 45 basis of rally. At this point of time, what we have done in our portfolios is that probably cut off some of our duration, that very excessive duration, go to somewhere a median duration of around, like where we are in our gilt funds and all holding a 10-year plus duration. Now we have reduced our duration a bit and moved to a 7 to 8 year old duration. We believe still that there is rate cuts. We are at the beginning of the rate cut cycle. So I would not say that the debt cycle, that story is over. Our perspective is that the next 6 months also would be very, very attractive for debt markets. You will be benefited by the rate cut cycle. And the another important point, Kavita, is that the banking liquidity has massively improved. If you look across at liquidity today and look, see that is actually been taken care in the part of the operative rate. The operative rate has fallen to 6 quarter. So our perspective is that without rate cuts also, the carry in bond markets as well as the beginning of the rate cut cycle, you would see definitely good gains in fixed income. And that is why we continue to advise our clients to invest in duration and short to medium term funds at this point of time.
All right, I think that will be all. Thank you so much, Devang, for being on the show and helping our viewers with their portfolio strategies post the rate cuts. Thank you so much. We'll slip into a quick break, but then post that, we still have Shweta Rajani connected with us. We'll be talking about risk involved in your mutual fund investment, and we will also get our viewers live on board and sort out their financial portfolio queries. All this and more after this break.